and good afternoon, everyone, and welcome to another Walker Webcast. I took last week off for my first full week of vacation since the onset of the pandemic, and I'm super excited to be back this week for a discussion with my two old and dear friends, Tom and David Gardner from the Motley Fool. Before I dive into my questions for David and Tom, a couple thoughts first. I'm back in our Denver office today and have about 6 to 10 colleagues with me in our office on a daily basis. We've established clear protocols at Walker & Dunlop for people to come into the office on a daily basis, and I find the work environment to be safe, quiet, and very productive. I checked, and today we have about 15% of our 930 employees across the country back in the office today. And we actually have a number of bankers and brokers across the country that are traveling to meet with clients and tour properties. I was just told this week that an asset we're selling in Florida has had over 20 in-person tours. That same property listed a month ago probably would have had 4 or 5 in-person tours, and the rest being done virtual. And so we're seeing people get back to actually visiting properties and traveling across the country to visit with clients. While I was on vacation last week and in Crested Butte, Colorado, I was impressed with how the local government had converted Main Street from two-way traffic to one-way traffic and took the extra space and converted it into outdoor seating and tenting for the merchants in Crested Butte. It made me think that local governments across the United States have the ability, and I'd suggest duty, to adjust the layout, permitting, and civic guidelines to enable commerce to happen in a safe and socially distanced manner. I realize that converting one street in Crested Butte, Colorado is a far cry from reinvigorating a major U.S. city, but I also suggest that with proper health protocols, local governments across the U.S. can take steps to stimulate commerce at this time while the pandemic is still running across the country. I was very surprised after last night's presidential debate, and I would say I'm challenged to call it a debate. The equity markets are up today, and the VIX has fallen almost 4% today to 25.27. For those of you who don't follow the CBOE market volatility index, the VIX hit a high back in March of 82.6, fell down to the mid-20s in late May when things seemed to be a little bit more under control. It spiked back to 40 in early June with the surge in COVID cases across the country, and has been in the mid-20s for most of the summer and early fall, other than a little spike back into the 30s at the beginning of September. The 10-year sits at 69 basis points today and continues to be the benchmark rate for massive volumes of refinancing activity in both the commercial and residential mortgage markets. I look forward to hearing Tom and David's thoughts on how and why the equity markets remain so calm while the world around us appears to be so wildly volatile. On the investment sales side of our business, we're seeing significant property sales activity at somewhat eye-popping cap rates. We are currently marketing a terrific asset in Nashville, Tennessee that will almost certainly trade at a sub-4 cap rate, and some indications of value having it going as low as a 3.5 cap rate. Cap rates like that used to be reserved for properties in Southern California with massive barriers to entry for new inventory. Obviously, where interest rates are today is having a big impact on cap rates and property values. Finally, from a credit and property performance standpoint, we continue to have de minimis number of properties in our GSE portfolio in forbearance, well less than 1%. And of the loans that have asked for forbearance since the onset of the pandemic, 91% are back paying currently. I was very pleasantly surprised to see that the Democrats lowered their expectations for a stimulus bill from $3.5 trillion down to $2.2 trillion earlier this week, and that Speaker Pelosi and Secretary Mnuchin have re-engaged in negotiations to see if we can get another stimulus bill that both the Fed and the Treasury have said is critical for our economy. I would note that the most recent proposal is a $1,200 per family check with $500 per dependent, as well as the Democrats are holding at $600 per week of additional stimulus or unemployment benefits. I have to think that the $600 per week number will come down if the Republicans are going to sign off on any kind of additional stimulus bill. Nonetheless, if we got a bill, very, very positive for the overall economy, as well as for the multifamily industry. So with that, let me turn to Tom and David. First of all, to the two of you, thank you so much for joining me today. We had, I think it was over 6,000 people pre-register for this webcast. So clearly people want to hear your thoughts and ideas on the markets. Just as a little background, Tom, David, and I all went to grade school together in Washington, D.C. and have known each other our entire lives. So this is a really fun one for me, given how well I know these two exceedingly successful gentlemen. You began Fool in '93 as a financial investing newsletter, which is the business that David had been in, and you named it the Motley Fool from Shakespeare's comedy As You Like It, where the court jester who could speak truth to the Duke without having his head lopped off. Talk for a moment about those early days, David, and you deciding to bound out on your own. And then Tom, why'd you decide to quit graduate school and go join your brother in this endeavor?
Well, thank you, Willie. First of all, thank you from both Tom and from me and from the Motley Fool. We're really delighted to be with all of you today. And Willie, it's a pleasure to join in with you. I note that I'm wearing a jacket, I guess, because I'm the only one still in Washington, D.C., hanging out, trying to bring some respectability, but I know you guys are out west and having a great time. So Willie, let me just say, the Motley Fool started as a labor of love. We were taught the stock market by our dad. He was never a professional investor. I remember your dad, remember our dads were all there at our middle school growing up, pitching in here and there. But our dad was a lawyer. The one thing he said to us is, Tom, Dave, you guys can't be lawyers. So that was the only requirement. Neither of us was. But I guess I fell in love with the stock market at the age of 18 and pretty much just decided to take the portfolio that Dad had built for me from age 0 and start to manage it. Tom did the same when he was 18. That's how things were at our family. Dad said, this is all you guys are ever getting. Anything else that I have when I die is going to your kids. So he had raised us on the stock market. And when it came time after college to figure out what we wanted to do, we started to write about it. And yeah, you got it, As You Like It. Shakespeare, both Tom and I studied Shakespeare. We love the fools, the fool characters who used some humor but could tell the truth. And in particular, I guess, before passing the ball away, I'll just say that we really started, Willie, from a Main Street orientation, right? We were not a Wall Street family. We were not working on Wall Street. I did work for Louis Rukeyser, the PBS host, for 1 year before we started the Fool. But from the beginning, we just loved the internet. We believed America Online was the internet in early days. We believed in AOL. And in the end, we've ended up picking stocks most of our lives and building a company that we try to do that for other people, mainly through subscriptions today. That's a big part of our business. So that's a little bit of an overview starting back in the day.
So Tom, let me just go to you on, after you guys had established the Fool, any thoughts about changing the name from Motley Fool to something sort of more sort of traditional or staid, like, Fidelity or Prudential, once you'd actually gotten going? And then the other question I have on the name is, has any investor actually tried to lop off your head for actually recommending a stock that didn't actually perform that well?
Well, we really never reconsidered the name. I think there's such a power in standing out when you're in a B2C world. So as investors would encounter our work online, they would see an option to read something from Bloomberg, which was probably outstanding, something from Reuters, probably outstanding, something from the Motley Fool. So if you're looking through a ticker page of news stories and you see the Motley Fool, you kind of have to click it. So it gave us a lot of first looks from people. Now, of course, we have had members tell us, I waited for a year trying to figure out if this was for real. So I missed some gains because I just really couldn't figure out, why would you call yourselves that? And there are a lot of reasons. David mentioned some, but I'll just say that in the financial services industry that we were born into in the early 1990s, still true today, but less so, thankfully. But in the world we were born in, you wanted to be contrary. Fees were very high. There were a lot of hidden transactional fees. Loads on mutual funds it wouldn't be unusual to have a 5% upfront load. There were a lot of people being taken advantage on Wall Street. And so to come in as fools, was a really nice position for us. Obviously, it does hinder us in some ways along the way. And in general, we've been suffered, our members and others have suffered our mistakes gladly. They've suffered the slings and arrows and the wins and the losses, the tragedies and the really great multi-baggers that we've had. Overall, our returns have been excellent. But yes, we've definitely developed data over the last 20 plus years, Willie, to show that we're right 65% of the time and we're wrong 35% of the time. And some of the 35% of the time that we're wrong, we're going to be really wrong. But the nice thing is you kind of max out a wrong call at probably like a 60% decline. Of course, there's a bankruptcy here and there in our past, but when you get winners, you get 10 baggers, 15 baggers, 20 baggers. The math adds up around a really long-term business-focused approach to investing, which has served us well.
I've tried to convince my wife that I'm right 65% of the time, but it doesn't quite work. So, David, you guys wrote the Motley Fool Investment Guide in 1996, and it, to a great degree, kind of put you guys further onto the map. And at the same time, it was met with what some would say some criticism of being a bunch of 20-year-olds trying to give investment advice to the world, and sort of, you guys are too young to really know what you're talking about. Talk about that time in the sense of the pushback you guys got, and then also how that's informed your thought about emerging businesses and investing in startup businesses that are trying to sort of go against the tide, go against the sort of conforming views.
Well, I love that you connect those two, Willie. That's such a good question. Yeah, because I think that it was understandable when we are in our late 20s and we've been on the cover of Fortune magazine and we're wearing jester caps, and the market's going crazy up, which it continued to for years, actually. We were on the cover of Fortune magazine in 1996 in the summer. The market topped eventually, obviously, 4 years later. But there was a natural association of these young, crazy guys with their caps and the idea that the stock market was overvalued. We didn't believe that it was. Tom and I don't spend a lot of time trying to determine what's overvalued or not. We basically made a lifetime commitment to the stock market, finding great companies and just buying and holding them. That's what we wrote about in our book. So in a lot of ways, I think our book would have come across in the same style or tradition of Peter Lynch or Warren Buffett, in the sense that we really do love just buying to hold in a world in which, geez, these days, fast forward 30 years, people are trying to make money inside of a second through very active inside of a second trading, right? So we have a very traditional message, but to hit the other second half of your question, Willie, we do very much favor growth. We favor risk takers. We love people like Eric Yuan, who Tom has gotten to know some from Zoom, just in the last year, or Elon Musk, who came to Fool HQ 9 years ago and gave a stump speech about what Tesla was working on, or Reed Hastings, or all of the entrepreneurs that we've benefited so much from buying, holding, recommending to millions of people to own their stocks and keep holding them. And so I think there is a willingness on our part, as Tom said very well earlier, to be wrong and to recognize that's part of a venture capital mentality, not just as stock pickers, but also, of course, as entrepreneurs, which all three of us share, working the businesses at the same time we try to figure out the markets.
So Tom, David's talking about cover of Fortune magazine in 96, which I remember distinctly seeing the picture of the two of you. And the next 4 to 5 years were an incredibly strong market. The underlying economy was growing, the dot-com boom hit, and you guys seemingly could do no wrong. You were picking great stocks, stock market continued to run forward. Talk about the growth of Motley Fool during that time, as you guys really knew you had something. How do you think about international expansion? How do you think about the brand and just general growth as you guys went from this really startup company into being a real name on Wall Street?
Well, that was the period during which we raised capital. We had been profitable out of the gate for the first couple of years without raising really any significant money, but we were kind of inundated by requests, and another friend of ours, we had a couple friends that were involved in helping to create the company. One is Eric Rydholm, who is the creator of some of the most popular shows on ESPN, pardon the interruption, and has had an incredible career at ESPN over the last 20 years, worked with us together in the first 10 years. And then Gary Hill's another one who came from Morgan Stanley and really helped us negotiate all of our venture contracts. He basically stacked up like 100 VCs, their offers against each other. And we got amazing terms. How we finance the company is a very strong aspect of our story, and some of that is the benefit of our dad and our family teaching us how to invest. What we didn't really have a lot of experience in is putting together a business model that stands the test of time. I think that's true of a lot of companies back then. That the value of $1 of revenue in 1999 is far, far lower than the value of $1 of revenue at software companies, SaaS companies, and technology companies today. So we've seen a real advancement in that category towards discipline, business model. So we were kind of 10 advertisers were driving our business. I think we did a great job with our brand. I think we really attracted a very large audience. I think we got smarter as investors together. We attracted a lot of talent to our company, but we really didn't have a business model that was built to last at that point. We had raised a lot of capital and sold a minority fraction of our company in the process of doing so. So those were very fun years. They were very productive years for us on a number of fronts, but they were years that lacked the foundation of risk management and recurring revenue distributed across a large audience of customers. We had concentrated, pretty much non-recurring revenue heading into the 2001, 2002 nightmare scenario.
Right. So let's transition to the 2001, 2002 nightmare scenario for a moment. Actually, before I get to that, David, as you think about 96 to 2001, there are lots of people today looking at the markets and saying valuations look a lot like they did in the dot-com run up and then bust. And there was a lot of talk about, but no, this time is different. And you would sit there and Globe.com would go public and everyone say it doesn't need revenue. It just needs a name and to be in the internet space, and up it goes. And we're sort of looking at valuations today on certain stocks, whether it be Tesla trading at 1,200 times earnings or other companies that have just lost all sort of sense of typical underwriting. Do you see any sort of parallels between that 96 to 2001 era and where we sit today?
I think there are some parallels. Sure. You just pointed to them, Willie. I mean, you've got the IPO market extremely hot, stocks sometimes doubling or tripling. That's happened in 2020. By the way, there were not many IPOs in the 5 years leading up to 2020. So in some ways, there's pent-up demand, and some very fine companies, by the way, coming public this year. But you also have the sense that, well, in this case, we have very low interest rates. And I think that's really fundamentally driving the incredible bullishness and the valuations that we see. When you have interest rates at or near zero, I mean, as you well know, interest rates compete with the stock market. If we could all just get a 10% interest rate, we wouldn't be as attracted to the idea of a 10% stock market annual return. But when we can't get much from our interest-bearing vehicles, the stock market looks much more attractive. So that's a good thing for the stock market and investors. I mean, I think that equities are the way to make the most money over the course of the most years. We've been invested pre-2001, post-2001, pre-8-9, post-8-9. Right here we are in 20. A lot of people were calling for the market to crash this year. It did. It went down 35 percentage points in 32 days earlier this year and then came roaring back. So you probably already know this about us, but Tom and I really don't spend a lot of time trying to explain the macro movements of the markets. We're more bottoms-up investors, just looking for companies that we want to be part owners of over years and years. And so, Willie, if this does end up being a time where, geez, remember Willie Walker's podcast, the Gardners are on and the market was at a top and 6 months later it's down 50%. If that's true, just understand that we weren't predicting it. We wouldn't be surprised by it, but we're prepared for it in a sense that it's happened before. It'll happen again. That's why we're invested for decades, and we're not ever focused on 1 year or too worried about the valuations in any given market. I will point out, just in closing, that the quality of companies today is far in excess of the 1999s and 2000s. drcoop.com, I don't see a lot of those types of companies today, the globe.com. I see really strong companies. I mean, Peloton coming public 2 years ago, really elevated valuation, but that's a company that's for real. So is Zoom, so are many of these others. So that's a difference that I see between now and back then.
So I got so much to ask you on that. One thing as it relates to, so if everything fell apart in 6 months, you said, we're prepared for it. Back in 2001, you weren't, to the degree that you had to scale down the Fool dramatically. I think you had to let go about 80% of your workforce. You had to scale back your international operations. So as you think about that time frame and as it related to the Fool, not picking stocks and whether drcoop.com or globe.com was going to go to $1,000 a share, but as how you were managing the Fool, the people inside of the company, your investments globally, et cetera, why are you better prepared today than you were back then to deal with that type of a fall off in the market?
That's a great question. I think maybe three or four points come to mind for me. The first is we were really team managed then. We didn't have clear roles in executive leadership. And so there really wasn't somebody who was saying, I take responsibility for that decision. So I think that level of accountability really matters. And that happens because we were a family company and a team-based company with and we've always been a very flat organization, but I think having clarity in roles, that's one. The second is recurring revenue subscription is a beautiful business model. And obviously for us, it comes in a digital form. We really don't send out physical product. We don't have inventory. We don't have substantial advertising business with receivables. We have a very, very clean balance sheet. It's actually, well, we see it in the SaaS companies. I would view us in a way as a business, as a B2C SaaS company that's giving investment advice and financial advice. And I think that whole category is moving remote digital. I think more and more of the financial advice and investment advice we get in life is just going to be digital through the convenience of all the tools that we're using, including Zoom right now. So these things play very much into our favor. So there were tremendous tailwinds now versus a lot of ambiguity about what was going to happen to these businesses back then. And then the last thing is we're just 27 years smarter. I mean, some of it is just time. A certain amount of it is just, we're going to have to make that mistake, I guess. And then we're going to have to make that mistake. You know, one thing I will say, Willy and David and everyone, is that I admire about our company, and it is about our company. It's about the soul of our company. It's a little bit about David and me starting the business, sure, but it's about the people at our company. We were very transparent as our whole business unraveled. It was devastating. There were a lot of tears. There was just openness. You saw what was going on, and we took our lumps. And I think that to a certain extent, I look at the business world today and over the last 20 years and look at the companies in the industries that just took their lumps. And I think technology gains a real benefit in 2001, 2002 by Jeff Bezos starting his shareholder letter in 2001, I believe, with the word ouch and just listing mistakes. And some of the bailouts that are happening, certainly in this bizarre situation we're in, are necessary. But businesses and industries really benefit from just taking the lumps at a certain point in time. And I will call out a company that, hey, it was an investor in ours early on. I think when you look at how America Online played out from that period, you know, they were settled a $300 million fine with the SEC for fraudulently creating $1 billion in ad revenue. So I think we benefited from being private, but we've always, from our roots, wanted to be open with our employees and with our shareholders, our VCs during that period. And I think that's essential if you're going to try and build a quarter century, 50-year, or in the case of Walker & Dunlop. How long has Walker & Dunlop been in business?
82 years.
82 years. And just reading through the Glassdoor reviews, and you know, Willy, how much a fan I am of the business you all are working on together. And just studying your organization and the openness of your organization, the teamwork. You really need to create a stakeholder-centric business in the world we're in today. And I think we've gotten smarter about that.
Yeah, I was reading a quote that you'd said, I think it came from the website, so I guess it's from both of you, which is take care of your employees, they will take care of your customers, and who in turn take care of your shareholders. And I couldn't agree more with that statement. We've always felt at WND that if we created a great place to work, sort of everything else falls in around that as it relates to taking care of the customers and taking care of stockholder returns. I want to, for a moment though, go back to the issue of 2001 and the conversion from ad-based to subscription-based, because I think that conversion obviously is what has allowed you all to create a business model that now has over 60 million unique viewers on a monthly basis to the Motley Fool products. It's fantastic what you've built. And the business model today is so much stronger than it was pre-crash and pre-layoff into the crisis that Tom just talked about. But that wasn't an easy thing to get accomplished. In other words, that had to happen. The dot-com world had to move from ad-based to subscription-based. And yet at the same time, as we all know, big publications like the New York Times and the Wall Street Journal at that time were really struggling to get people to actually pay for the content they were getting over the internet. What's the analogy today? Like what are people betting on today in the virtual world that they're getting in a certain form that is going to have to change to make durable business models? Or do you think the way that SaaS is being sold, or the way that electricity is being sold for electric cars are basically being given away? What's the conversion that has to happen to make what everyone sees as this great value generator actually create durable returns? Is there one?
Great question. I'll need to think about that latter part of it, Willie, because, and maybe Tom has a good answer. He can chip in here. I do want to say that going back there, we'll maybe revisit 2001 one more time here. But yeah, the preceding 5 years, you really couldn't charge on the internet, as you pointed out. I mean, the newspaper companies, they had other problems, because I'm not sure you need that many local newspapers. In a pre-web world, everybody had their local newspaper. There were a lot more banks back then too, but once everything starts to go digital, how many different newspapers do we need? How many different banks do we need, et cetera? But so I would say Tom and I kind of grew the Motley Fool in those early years in an environment where we frankly just could not charge. We would have been laughed at if we'd said, hey, by the way, this is a pay thing on our website. That, as you'll remember, Willie, that just was not happening. So as 2001, everything came crashing down, one of the bets that we made for 2002 was, well, what if we go back to our roots? We started as a newsletter that was a subscription product. Turns out mainly it was just family and friends that were paying for it in that first year before we got onto AOL. But what if we just go back to that? We didn't know that it would work, but we actually contracted with an outside firm, Phillips Publishing, in the same way that Simon & Schuster published our books. We had our newsletter, our first one, Motley Fool Stock Advisor, outside published. So we just got a royalty each month. And as that began to succeed and that subscription model kicked in, that we're all talking about how much we love that thing, all of a sudden we were like, hey, let's buy that back from Phillips. I mean, if we could buy back our books from Simon & Schuster, that would probably make sense too, but let's buy that back from Phillips and make that a big part of our business. So adding that subscription component, and of course some of our best stocks have had a subscription component like Netflix. We love the businesses that do that. And Willie, your question about what's the thing that we can't do now, like is there an equivalent of, we couldn't charge back in the day. Is there something in 2020 that you can't do? I don't know that I have a great answer for that. I think that analogy to electric power, like freely juicing up your increasingly electric car with free electricity, is probably helping Tesla right now, although more recent buyers are having to pay some for their electricity. That might be a good one. One other idea that's a shot in the dark, but I do find that there are a lot of subscriptions out there. How many subscriptions do each of you gentlemen have in your life right now? So I'm starting to wonder if people who are operating off that model are taking for granted that everybody else is going to want to subscribe to their thing too. Mm-hmm. And maybe there's some forms of subscription management or curation that middlemen could come in and make better, so that we don't all just get nickeled and dimed to death by subscriptions in our lives. But I'm just making this up, guys.
Well, I mean, I'll jump in on that quickly and say I agree with that. I think when you look at the marketplace of B2C and B2B, in general, think of the individual at home or the family managing subscriptions. They need bundles, they need simplicity, they'll pay up for it. So there isn't a lot of disruption that comes in underpricing those, whether it's Amazon Prime. You start to get pricing power if you're Apple by getting people to come back to your solutions again and again and be able to rely on them and integrate them. When you're in the B2B market, there's a lot more willingness for companies at scale to patch together different solutions. It's not just one individual or family trying to manage a whole bunch of different subscriptions. It's a company that's looking and saying, we could use Blackline, we could use HubSpot, we could use Atlassian. Now there are the benefits of integrating it on a platform like ServiceNow that start to come in. But in general, I would say, I love the question, Willie. I agree with David. It's a hard one to answer. If I'm taking the question correctly, it's what's going to happen now for these SaaS companies or a company like the Motley Fool to make the journey to the next stage, and what skin is going to be shed, and what's the new company going to look like? And I would just say, I think that you're going to have excellent retention rates. So an excellent dollar-based net expansion rates. Those are very strong indicators for those businesses. And then the second thing, I mean, there are a few others, but I'll just say the second one would be that you're moving towards machine learning and AI, because it's not just that automation, and I know of the technical sophistication at Walker & Dunlop. It's one of the reasons I love your company. It's those businesses that are constantly pushing forward to find the next applications and the next technology that they can use to make their members' lives easier, more productive, and to bring costs down. I think the automation side of bringing costs down is a little bit overrated. It'll be a very nice thing, and gross margins will go from 79% to 83%, and that's great. But really what you're doing is you're simplifying your customers' lives and getting them the best IP to help them make better decisions. So I think the companies that miss out on machine learning and AI and that don't have great retention rates and aren't expanding their customer relationships are going to be the ones that get left behind. And those companies, by the way, will start making acquisitions, and their growth will degrade, their goodwill will pile up, and all of a sudden we'll start to realize, although they had great tailwinds and were in a great category, they were actually the second or third tier businesses.
I think your description there, Tom, as it relates to successful business models not being so much focused on, if you will, eliminating costs, while they will eliminate costs, but eliminating friction in the client experience is something that we at Walker & Dunlop have really been focused on a lot. And I think if you think about companies, like a couple that you've mentioned, if you think about companies like Amazon or Peloton or Warby Parker, if you go and use those companies, the user experience has no friction to it. They've eliminated the friction points. And by using technology to eliminate the friction points, it just makes consumers want to go back and go back and go back. And it's something that we've been very focused on at W&D, and I think it's the real key to successful technology companies going forward. You mentioned Zoom previously as well. As you know, Eric Jan was on the Walker Webcast about a month ago, a little less than that. And you sit there and you say, how can Zoom compete against Microsoft and Cisco? So, it's a worthy question. Here's this startup going against these massive technology companies that, oh, by the way, have been in the space for years. He left Cisco to go start Zoom, but the simplicity of that Zoom entry page is almost so simple that you can't believe it. Like, you sort of expect by now that they'd have all these other icons on there, yet when we all came into this, it's the same 4 dots. And you know exactly what you're getting, and the user experience is frictionless. And I want to talk about Zoom in a second, but before we dive down to specific stocks and questions that I have for both of you on your portfolios, and we get to REITs and commercial real estate and things of that nature, you both mentioned Amazon and Apple and Netflix. 15% of the S&P 500's market cap today is FANG stocks. Does this concentration in those big names concern you?
It doesn't concern me in the sense that I don't lose any sleep over it. And those are stocks that we've recommended and held for, let me see, Netflix 2004, Amazon 1997, Apple 2009, right? So these are all 10 plus year positions. And for Motley Fool members, and I know some of you are watching us right now, you know that we've just held them. And sometimes we've added to them because we like to add to our winners, not our losers. That's been part of our investing performance. And so, Willie, I guess I'm delighted to think that we co-owned all these companies as they succeeded in the wildly effective ways that they have. I think in most cases, they've succeeded because they've pleased their customer. They've, for the most part, not made big mistakes. For the most part, they're doing good things in the world that people want more of. People can criticize Jeff Bezos across 7 different dynamics probably. I don't spend a lot of time with that myself. I'm extremely grateful that we were living when Jeff Bezos was on this planet, because Amazon has been a lifesaver for a lot of people here in 2020. And the whole move to e-commerce and logistics was driven by that company. So while that occupies a significant part of the S&P 500, there's a whole ecosystem that it's in part ways responsible for spawning and growing. And that's also true of Apple and so many others of those great companies. So Willie, I guess I'd love more companies to be that awesome, so that rather than chopping down the Amazons and Apples, we just see others rise and gain some more market share of the S&P 500 themselves. And, I think we might continue to see companies like, I hope, Zoom and a number of others do that, rise into valuations that start to dilute the big dogs that have been the 4 or 5 horsemen that have run roughshod over competition as they made our lives much better and made us a lot of money as investors.
David, on that, let me just dive into that for 2 seconds because I love the answer. But as I was pulling notes together for this today, you just said that you've owned, let me get this right, Amazon since the late 1990s, Netflix since the mid 2005, 4 or 5, and Apple since 2009. And incredible stocks, all have had incredible performance subsequently. As I was putting together my notes for this, I thought about, let me think back to let me ask David and Tom of a stock that they would want their grandkids to get. And I went back to 2 stocks that my grandparents both loved. One was GE and the other one was Alcoa. And so I went back to 1989 when I graduated from college and looked at GE and watched it rise between 1989 and 2000 from $4.50 on GE up to $60 a share, and on Alcoa from $18 a share in 1989 up to $91 a share in 2007. And so you sit there and you say, man, in 1989, those were great picks and they were great long-term holds. And yet at the same time, I think everyone here knows GE's almost back to that 1989 price. It almost touched it this year. And Alcoa is down below that 1989 price today. And so I guess the question as a long-term investor, when do you know when that arc has peaked?
Well, I think that the important thing is to ask yourself about the relevance of the company, what it's doing. Is it innovating, which is, to me, the biggest thing? That's the word I chase in life, is the word innovation. Who is the innovator? And certainly, I'm sure at points Alcoa was, although it started to get out-innovated by companies like Nucor and some others that came into its area. But, so I think you have to look at the companies that are innovating. And while we can definitely look at General Electric as a great example of, in some ways, everybody's safe stock, and Jack Welch being on the cover of CEO magazine saying this is the CEO of the decade and that sort of thing, I don't think ultimately his approach to business was ready for the next generation, which is looking more for conscious capitalism, something that means a lot to Tom and to me. We could talk more about that if you like. But, it was a command and control militaristic model where they needed to be 1 or 2 in every one of their markets and would acquire their way into it if they needed to. And ultimately, the world just kept changing. And I don't think it's a very innovative company, and the leadership wasn't really rolling with the times. So, I think about a company like Mars. How about Mars? That's a company that's been around longer than our own lifetimes, guys. $38 billion company today. It's a private company, so it's not as well known. But that's a company that probably, if you bought and held over, since your grandparents had it, if they could have, they'd probably be happy today. So I don't think it always ends badly, but I think you have to be watching who's innovating and who's relevant. And if I see those things changing, I start thinking about selling.
So Tom, your top 5 picks are very technology focused, and David's top 5 picks right now have a little bit more diversity to them, if you will. He's got Lululemon and he's got Take-Two, which is a big game maker. But you're very much focused, very tech innovation focused, with your top 5 picks right now being Fiverr International, ServiceNow, Slack, Zoom, and Zscaler. Talk for a moment about, and all of them are technology companies, all with significant insider ownership, all with large addressable markets, and all very expensive right now. So why do you like these companies? You're on mute, Tom. You're on mute.
Sorry, I had a fire engine roll by. I'd say the first thing, thankfully, is that those have been purchased along the way. So we've enjoyed great returns from them. And then the question would be, would you buy them now? My answer is yes, I would buy them now, but I would not buy them now for anyone who has less than a 5-year time horizon. So my work specifically, but I think overall the Motley Fool is pretty much out there saying, if you can't hold it for 5 years, it's probably not a good idea to invest in it at all. And some of the reasons for that are, when you actually look at the performance of the market over long periods of time, a very small fraction of companies drive the majority of the returns. If you go back 100 years, 1 in 25 companies has driven all the returns. In fact, 80 public companies out of 25,000 over the last 100 years are responsible for 50% of the market's gains. So really what we're trying to do for long-term business-focused investors is try and find what companies do we think will stand the test of time, like Starbucks, which is up 20% a year since 1992. There's a lot of puts and takes in any given year, and Starbucks has had declines of more than 70% in the value of its company along the way. But looking for the elements of what really drives great results over long periods of time. And when you look at those businesses, I'll just anchor on to read about the founder CEO of Zscaler, who has a history of success in security companies, cloud native security business now, and said after selling the prior two, I'm not selling this one. This is the one I have the capital and I'm doing it my way. He grew up at the foot of the Himalayas with no electricity or running water. So I love the life stories of the chairman, CEOs, and founders of these companies. They matter to me in this world and in my investment approach. So Zscaler right there, Zoom, Eric Yuan, his life story and the business that he's created, ultimately for a financial metric, just to trot one out here. I think that these businesses that are really efficient in their use of capital are indicating something to us and growing at a high rate. So again, it's the quality of the revenue, and sorry for a mathematical formula, but if you take the working assets, so you back out cash and add back debt, you take the working assets and see how much do they generate in gross profit for each dollar of asset investment. Those 5 companies, you're looking at some pretty extraordinary numbers out there. Like Fiverr is an extremely well-run Israeli-based business that is helping freelance workers and businesses and consultancies come together and help companies that are in need for talent remotely around the world. So there's a big tailwind there. It's still a small cap. So last point is, although they are all tech companies, kind of so is everything. So is W&D. I mean, my favorite companies are going to be the tech leaders in their category, and I really love the Mark Andreessen article in 2011, Software is Eating the World. That has proven to be true, and all of these businesses, all the categories that we look at are being disrupted by software, and I'm looking for those companies.
Can Slack and Zoom both be winners?
I think they can. Part of it is I think that the markets for those businesses are enormous. I think Zoom has an advantage right now because there was absolute necessity for Zoom, whereas Slack does have something of an alternative in what Microsoft Teams is doing. I mean, essentially, Microsoft is looking at all these SaaS companies and saying, let's replicate as much of this as we possibly can so that we can provide it to our large enterprise clients and expand their spend and maintain their relationship. But these companies are the innovators out there. And I'd say Slack with Stuart Butterfield and just all of the components of what Slack has created. They have an elegant design to their applications that is unique. And yeah, I think both of those businesses, I think they partner, and I wouldn't be surprised to see them partner more and more over the next 10 years.
Your analysis on Zoom, you kind of get to the valuation as it relates to the growth in revenues and how they just continue to, I think the expectation for this year was 750 billion, and then 750 million, and then it went to $1.2 billion, and then it went to 2.6. And you've been running your numbers saying, and if all this works out 5 years from now, this valuation actually makes some sense. But it's not like Zoom is the only one in this space. It's not, I mean, one of the things that David talked about Peloton previously, I want to talk about Amazon trying to enter the fitness space, because quite honestly, if Amazon focuses on your space, watch out. Why is it that Microsoft and Cisco can't all of a sudden say Zoom's revenues are now $2.6 billion. We would like to have, that $2.6 billion. We're going to focus in on this. This isn't rocket science. And we're going to go and disrupt this space and make life difficult for Eric and Zoom. Why do you have such confidence that they can hold this distinct market positioning?
Well, I think the first thing is that the market is so large. I mean, I think you could make an excellent argument that Zoom, from almost a position of, I wouldn't say irrelevance, obviously they were a successful company already, but semi-unknown a year ago to be one of the top 25 brands in the world right now. I think you could make that argument, and that's a transformation like we've never seen before in history. And obviously that's what's happening in the business world. You can create applications that could become relevant. Obviously you have outside factors that have accelerated this, but those applications can have a worldwide audience and can become a very important brand in the world. So I think the market is so large for this. The other thing I'll mention is that Eric Yuan, as you said before, was at WebEx before, and he left WebEx. And Eric Yuan, as I'm sure you experienced in the conversation you all had with him, is he's not a trash talker, but he is an honest person, and he went home every day ashamed of the customer feedback he was getting at WebEx. And so he went to like a shared workspace and sat there and said, what do I want my company to be all about? And the first thing is like, I want customers to be happy. Any customer isn't happy, like that's a problem for me. And I want my employees to be happy too. And I'm sure he may have shared this, like if you are not happy today, don't come to work. Yeah. It's okay, you're not happy this week, don't come to work, because if we even just get a fraction of our employee base that is happy to come to work today, the outcomes we can get will be much bigger than if we're trying to manage an uneven dynamic. So I think that happiness dynamic for Eric Yuan had him create software designed to work on the slowest speeds, whereas the others were creating high-speed, professional, B2B connections where if you drove into a tunnel, it was gone, or anything that threw off your signal. And so we all had that Skype experience or that WebEx experience of just doesn't quite work. And how does Zoom work so well? Because it really built its applications from the ground up.
So I want to, first of all, I was amazed when I was talking to Eric about his focus on happiness. And I was like, I was all expecting him to tell me about why Zoom is such a great company from a technology standpoint and all this. And he kept going back to, I want to create a happy experience. And I think that gets back to the friction issue of he's created Zoom to remove friction. All the friction you just talked about with Cisco and WebEx and all that stuff. I've been in the fanciest conference rooms on the face of the planet with all the Cisco cameras and panels and all that stuff. And after someone spends $500,000 to get the whole thing set up, the person on the other end of the call doesn't have the same equipment. So all that investment in high grade technology goes out the window because someone's sitting like I am in my office right now on the low tech solution. But I want to loop back, Tom, on you as it relates to remote work and getting back to offices and how that plays into commercial real estate. But before I do that, let me jump to David for a second, because your portfolio it has tech in it, but it's a little less tech heavy. You've got Etsy, you've got Lulu, you've got Reiku, you've got The Trade Desk, and you've got T2. Two in particular that I want to talk about. One of them, because my great friend Strauss Zelnick runs Take-Two Interactive, and I'm a huge fan of T2 and would love your thoughts as it relates to gaming and where gaming goes. When I had Eric Yuan on, I talked about the confluence of video conferencing and gaming, and there's no doubt in my mind that those two things kind of clash as it relates to people coming together to be creative and to play with each other and work with each other and what have you. And I'd be interested in any thoughts on that, David. And then the other one is Lululemon, because it has such implications for retail. And many people who are listening to this call are in the commercial real estate space and own retail assets. And I went to the Cherry Creek Mall with my kids last weekend. I walked through Neiman Marcus and I could have thrown a stone and not hit anyone. And we come around the corner to Lululemon and the line is out the door, and it was an hour and a half wait for us to get into Lululemon. So my question to you on Lulu is, why has Lulu been able to succeed when other brands, whether it be Tommy Bahamas or Ann Taylor or a bunch of other leisure brands, have not done the same as Lulu? And then my second question to you is, will any of us ever go back to Brooks Brothers and buy another tie?
Well, with the bankruptcy, that's going to be temporarily difficult. I already have probably more ties than I needed at the age of 54. So, I mean, maybe we were all over-investing in things that made more sense last year. We'll find out, Willie, how much, and Tom, how much the world changes from what we thought it would be. A lot of us are projecting 2020 permanently going forward. I think that's a little bit of a myopic view. I do think that a lot of the things and habits we got into pre-2020 will come back. I do hope that Brooks Brothers does come back. With Lululemon, Willie, you first and foremost, you have a brand that was brilliantly managed. You have a category leader. You have a female-focused business, which I like a lot because Wall Street is so often so male-dominated. Fortunately, less so today than ever before, and probably even less so next year. There's some wonderful trends in place behind female energy taking over the world in lots of different ways, and I vote for that. But stocks like Lululemon or Etsy, these are traditionally more female-oriented businesses and get overlooked, I think, or not as included when people think about, what are the real winners out there. There was some bad management at Lululemon, you might remember, the founder and some of his comments, and ultimately he took himself out of the game. But brands have a way, I think, of managing through and evolving and adapting when they mean that much to people. And that's the thing about Lululemon that I love, is that people who love Lulu love Lulu. It's the same as a Starbucks kind of premium brand positioning. People love Starbucks, the people who love it. Lululemon's also expanded more toward men. I don't have my Lululemon pants yet, but I probably might in the next year or so. A lot of other guys do that are more fit than I am. So I think it's just an example of a great brand that had raving fans and just fought through some difficult times. And by the way, the stock, if we were having this conversation 4 years ago, we wouldn't be talking about Lulu as a big winner, right? And so you have to remember, at different eras, companies can make comebacks. In some ways, the Motley Fool, as you talked about earlier, Willie, we're kind of one of those stories. We're kind of a comeback story. So we've seen it happen. And then really quick on Take-Two, I didn't know Strauss Zelnick was a good friend of yours. That makes me like it more. But Take-Two Interactive, as a lifetime video gamer myself, it's a stock that I've just had as a recommendation since 2007. It's up 9 or 10 times in value since then. The market's up, tripled since then. So I mean, it's like we're up 700%, 800%. The market's up 200%. So it's been a substantial outperformer. But then again, the market's been strong over these 13 years. A lot of people are talking about interactive entertainment being the next social medium. Like, social media are moving into the games world, and games as a service, initiated in a lot of ways by Take-Two Interactive with the great success of Grand Theft Auto 5, which started out as a game that you bought 8 or 9 years ago. All of a sudden, you were subscribing to it as they added more downloadable content, and then people are still playing it, like World of Warcraft, another great stock, Activision Blizzard, years and years later. So the world has changed and made games themselves count for more. It's a much bigger business than Hollywood today, and people are living and spending time in those worlds in a way you just don't with a 2-hour movie.
So I want to switch to commercial real estate for a second and overall real estate markets, because a lot of people listening today are invested in and want to get your sense of it. We've talked about a lot of, high-flying tech companies, and as a publicly traded company, I'm obviously envious of the multiples at which many of the companies we've just talked about trade at. And at the same time, there is value in bricks and mortar, there's value in dividend payments, and there's value in long-term return. Can we talk for a moment about thoughts on things like the retail space in Simon Properties, the office space in Vornado, hospitality in either Marriott or Hilton, multifamily in Avalon Bay, or single-family housing like Lennar? Tom, let me go to you. Any thoughts as it relates to what you kind of like, given what this pandemic, David just said, we all are kind of thinking that we're going to stay in this forever, and we're obviously not going to stay in this forever. It's had very dramatic impact on things like retail and hospitality. But we all know at some point we're going to go back to a hotel, and at some point malls, the good ones, are going to be back up with a lot of people and be very vibrant places for people to shop and to eat and to interact with other human beings. What are your thoughts on commercial real estate? And then I do want to get to multifamily versus single family in this urban flight that's going on. But let's focus just on the kind of 4 major food groups of commercial real estate for a moment.
Sure. Well, first of all, it's important for David and I to both say, or at least I'll say, because I think it's true of David too, but we're not experts in commercial real estate. It's not an area where I've made a lot of investments in my work at the Motley Fool. So I can talk a little bit more about trends and things that I think and observations I've had about how markets change. The first thing I would say is that while I do believe that we will return, I think that the return will have some permanent change. And I think the permanent change to study is what is happening in your life or my life or our lives that actually is somewhat beneficial. Are there benefits to not having that same commute you had every day if it was 40 minutes both ways? What freedoms or benefits in this otherwise horrible scenario have emerged, and what do we think that's going to change in behavior going forward, and how will that affect how we use commercial space? So of those categories you've mentioned, I'm pretty resistant to getting excited about retail. I just think that area is so challenged. Shopify, talk about removing friction. Another person, a really great person for you to interview, Willie, if you have time in your schedule in the year ahead, is Toby Luca at Shopify, or Harley Finkelstein. They are developing in their own way a commercial a real estate company for merchants online. and they remove friction everywhere they possibly can. And I think that you're going to see so much retail realize that the margins are actually very good. The process is relatively seamless, and we should be banking on online same-store sales growth and building our business around that. So I see retail commercial REITs as really challenged. I would say hospitality, I mean, you know, you read like the Palmer House, which you would never have thought would possibly vanish in Chicago, and see its value cut in half in its latest appraisal. So obviously that's a devastated area as well. I'm a little bit more long-term positive on that. I think Marriott is a great brand, great long-standing brand, and I would bet on the return of travel and maintaining protocols in hotels and hospitality more than I would on retail. And then office, to me, is just gonna, again, rookie, amateur, but I would just say I think it's going to be significantly changed. I think it's the safest area, and obviously you have businesses that are paying their rents, and so those businesses are much more stable in office REITs. But I think just at the Motley Fool, we're talking more about regional offices than a big headquarters. And some of that is, what are the benefits of this experience? Well, some of it is you can be more mobile. And do we really need to be in the same place when we have Zoom, Slack, and other tools? We've proven that we can work with our 500+ person company fully remote since the first week of March. So I think there will be returns, but I think the changes are coming, and the way to figure them out is what change benefits the world. And so I think there will be a reduction in the use of office space. But there may be more spreading out, more offices, less open floor plans. It's going to depend what happens. There are a lot of things that remain unknown, but I'd say office REITs to me are the safest of the group.
And then David, on housing, single family versus multifamily, urban flight versus, you know, cities are cities and New York's back at some point. What's your take on that? In other words, would you buy Avalon Bay over Lennar, or would you buy Lennar over Avalon Bay?
So I'm going to give an answer, but I'm going to say what Tom said again, which is that I don't really invest much in real estate. In fact, I only have one.
But you've got all these other investments that are impacted by the way all this happens. So you're
right.
You're looking at those investments and thinking about how this happens. So, but like, for instance, the people going to the mall to buy Lululemon and the suburban setting, are people moving out of cities to suburbs? And do you see that as being a big driver of economic activity, or do you think the city survives?
Right. No, I wanted to say that American Tower has been my only REIT, and it actually reorganized as a REIT after I'd recommended it 2 years later. But I mean, you know, so I like American Tower. How about that? You know, just from a REIT standpoint.
It's now Colony, right? It's now part of Colony. So, I mean, they've kind of, Colony's taken a turn and took a massive beating on their hospitality ownership, but they are converting that company in a very dramatic way from being a bricks and mortar real estate company to actually being more of a technology focused real estate company, which is going to be a very interesting thing to watch if Tom, Barrick, and Mark can actually convert that company successfully from a traditional bricks and mortar to more of a technology company.
Very well said. And so the 5G build out. And so to the extent that I have insight or ideas, it would be acting on things that relate to the build out of technology in our world. And that's why that kind of business and what you just said, Willie, orients much more with me. I do want to mention that we do have some good REIT analysts at the company. And so I can share some of the words from Matt Frankel, who is one of our analysts, who's not a big fan of mortgage REITs as long-term investments, but really likes actually Walker & Dunlop, which has been a recent recommendation.
I didn't ask you guys on to say that, but I'm very appreciative of it.
In no way was it tied to this conversation. That is a decision made independent of Tom and me, 100%. But you know, because of your focus on multifamily, and I do think that that's very forward-looking, and we do need more of that. We need less single family. We need more multifamily, and so that's important. Obviously, real estate has not been a great place to be in 2020. It's down about 14% on the year. But I'll give you an example of a REIT that our team particularly favors, and it's Store Capital, ticker symbol STOR. Virtually all of its properties have reopened. Only about a third of them were in COVID-sensitive industries in the first place. Rent collections at 85%, steadily improving. Stocks down 25% in 2020. So when you focus on quality, well-run businesses with strong balance sheets, whether we're talking about REITs or all the other companies we've mentioned this hour, those are the stocks, the companies we want to be invested in.
It's great. So I got one final question for the two of you, and we're going to wrap it up, and which is that, you guys are long-term investors, and throughout our lifetime, all we've done is watch the equity markets go up. Yes, they've had corrections and what have you, but if you've been an investor and actively investing and holding for the long time, it's been an incredible return. What's the biggest threat to the long-term value of U.S. equity markets continuing to go up? Is it political unrest, protectionist trade policies, our national debt, the dollar loses its role as the reserve currency, or some other threat that says that, if we stay the course for the rest of our lives, things in the equity markets keep going. But if David, you said previously, there's not a lot that keeps you up at night. Is there something along those lines that would be the catalyst to the equity markets really losing value?
It sounds like you want an answer from each of us. I'll give a quick one and pass the ball to Tom. Willy, thank you so much for a wonderful conversation. We've had such a good time. I think for me, we need to hit the golden mean between understanding that capitalism is a beautiful thing and not letting capitalism wreck things. And so I worry that people don't appreciate capitalism and all that it has done for us. We are taking so much for granted today, Zooming, from Washington, D.C., Denver, and California, and having a conversation in front of thousands of people. All of those things are small miracles when you think about where the world was 100 years ago. And most of that is due to ownership capitalism, people taking risks, entrepreneurs, venture capital, and trying to make a product or service that people would actually want to buy that's better than the next door over, right? So we have to recognize that. And to the extent that the younger generation is not learning that or is falling out of love with that, that's a problem. On the other side, we have to make sure capitalism is the best form that it can be. We need a better form of capitalism than the one we three grew up with. We need less Enron. We need a lot more Lululemon and Starbucks. We need companies and entrepreneurs to take risks, but please all their stakeholders. And the CEO of our company, my brother Tom Gardner, has done an outstanding job managing for all of our stakeholders, from our shareholders, yes, but right through to our customers, partners, suppliers, and employees, and a couple other stakeholders besides. So we have to hit that and not lose that.
Tom, final word.
Well, we're certainly going to move into an inflationary time, but that hasn't wrecked the equity markets irreparably. I would just echo what David said. I think that capitalism wins and the markets win the more people feel that they benefit from it. So the more it looks fair, that everyone has an opportunity to succeed, no matter their age, their gender, their ethnicity, their cognitive process, and a number of other factors that all of us as organizations and individuals can get smarter and more enlightened about the journey that each person is on and different groups of people are on in their life, and how to make their journey woven into capitalism in a way that they benefit. So I think every company should have employee ownership, right? And every company needs to start using tools to allow their employees to share where they're frustrated and what's not working, and to get that data all the way through to how companies are financed and whether we're really building long-term mindsets. The more that people see scalping and jumping in, like I got my commission, I'm going to my gated community because I made what I need to make, the more that develops, the less chance there is for a really healthier form of capitalism to emerge. And capitalism is going to win if it gets healthier every decade in our lives. And so it's something that we all have a stake in. But we need to make sure that every adult and every child, every kid starts getting invested, as our dad taught us when we were kids. So there's a lot of great work to be done, and I'm excited, most of all, probably about the people we get to meet along the way, and Willy, the fact that we get to reconnect with you at points along the way and remember what things were like when we were all 7 years old playing mall ball. Mall ball?
So
yes.
I'm extremely appreciative of both of you for taking the time. I'm super proud of all that the two of you have accomplished, and I'm honored to have you guys spend an hour with me and give some insights to the people who joined us today. So thank you both very much. Thank you everyone for joining us. We've got Mark Zandi from Moody's coming on next week on the Walker Webcast to talk about the macroeconomy and what 2021 is going to look like. Thanks again to Tom and David, and I hope everyone has a great day.